Hi everyone, welcome back to my channel. In today's video, I will be discussing about long-awaited our topic, that is private equity funds. So let us understand what our private equity funds are. So in the earlier videos, you understood about and we have seen how the mutual funds would work, and also we have seen how the hedge funds would work. In this video, I will explain you what our private equity funds are. So in the very simplest language, private equity funds are nothing but it's a kind of fund which invests into private companies. Very simple definition is a fund which invests into private companies. Now, how the private companies are defined, what kind of companies they invest, we will discuss going forward. So first of all, I would to make it easy, I would write down the like what all the features of a private equity funds are. So first of all, they invest into private companies. This is very important feature of a private equity fund. That is very clear. Next, understanding about the risk profile, right? So the question comes after understanding mutual funds, hedge funds. The question comes: how about private equity? Where do they stand, right? Like whether they are also risky or they are like less risky compared to like mutual fund and hedge fund. So my answer to that is it depends again how what kind of fund structure it is. If it is a complex structure, then definitely it would be a risky fund. But most of the time, private equity funds are considered to be riskier when compared to the mutual fund. The reason is they invest into new ideas. Okay, let me define this also while I explain you this point. So private company means they invest into privately held companies, private limited companies. Also, they invest into some kind of venture capitals, right? They are the private equity funds are the venture capitalists. What do I mean by that? The meaning is they invest into new ideas, right? There is some person who is very talented, who is very skilled, and he has got some idea, some research. Maybe he has done on some product. He wants to introduce that product into the market. What he does, he will reach out. He might need a lot of money for that to launch that, but he is a poor guy, not able to fetch that much of fund at this point of time. What he simply do is he will reach out to some big players like private equity companies or the fund houses. These fund houses, in turn, they will invest into such companies. They are considered to be called as venture capitalists. So they invest into some kind of idea, and when idea goes very successful, then both the parties, the idea generator or the people or the private equity funds putting the money, all will get benefited. Simple example is in India you have seen Zomato, Swiggy, Flipkart. These are all examples of the venture capitalists. Like once upon it was an idea, just an idea. As it evolved during the time, idea got successful. Somebody put in money there, and you know how the life is going on with them, right? Okay, so risk profile if they are investing into company. Okay, on the other hand, we have discussed if the things are going good, both the parties get benefited. How about like the idea is not getting success due to some reason the idea is not so good. People did not like that. In such cases, what happens is they will go in bankruptcy or the whatever the money private equity fund invested into that privately held new company or the new idea that will go in vain. In that case, this is to be considered as very risky. So it depends on the kind of structure, and also in other hand, if my private equity fund is investing into derivatives and complex securities, complex structure, open market, that also makes it very risky. Now the question comes, who can invest into a private equity fund? That I want to call it as an investor base. So similar to hedge funds, private equity funds also have the some kind of accredited investors. What do I mean that by that is, let me read, so accredited investors are nothing but there are certain criteria set up by in each country for this defining this terminology. Okay, so this terminology it will have some kind of qualification and some kind of risk taking appetite or the licenses. Okay, and also some kind of experience. Okay. So there is a certain way of like defining. So only accredited investors who can like take good amount of risk, they only invest in. And the word accredited investors is used here very commonly. What does it mean is it is defined in the like as per SEBI in India, and as per IRS it would be like defined in a different way, like wherein someone to be called as accredited investors, it should be they should be having some kind of qualification, some kind of certifications or licenses, some kind of experience also. It is needed to be called or come under the accredited investors. Moving on. Now the question comes how regulations would work or how strict they are in terms of regulation. In mutual funds, we understood that mutual funds are very highly regulated, right? Okay, and we also understood that when we say they are highly regulated, it means they are uh, bound to publish their reports, they are bound to give a lot of reports to investors and the other stakeholders, and we understood that in case of hedge fund they were less regulated. So I would say in the case of private equity funds also they are very less regulated comparatively they are very less regulated. What do I mean? They don't have to publish a lot of things, they don't have to do uh, uh, in get a lot of like reports out. There are many things which are like not applicable in terms of like from the regulator side for the private equity funds. Now we'll see who will manage that. Who will manage that? So private equity funds are again managed by some professionals who are considered as fund managers, and they are also called as very famously known GP, that is the general partners. So in fund accounting, the terminology for the fund manager or the portfolio manager is a GP is also called as a general partner. So general partner is a who is a general partner? So general partner is a person or the group of people who are very experts, who are very qualified, who knows where to invest. They have big profiles actually. So they are the actual people looking at whom, looking at their qualifications, people invest into the private equity funds. Okay, so they are the like highly qualified people. They know where to invest. They know what all decisions to be taken at the right point of time. So private equity funds are very highly managed by the uh, professionals who are very qualified. Now the next question comes: what is the minimum investment if somebody wants to invest into private equity fund? Unlike mutual funds, wherein we discuss 500 rupees is enough in India if you want to invest, and in US we discuss 50 to $100 is enough for investing into a mutual fund. But in the private equity funds, if you are talking about, that is like not the case. For the private equity funds, you require big sum of money. Just say 1 million in US terminology, or in Indian terms, it's like a 10 lakh rupees. So you can understand 10 lakh rupees is not a easy thing for the like, common man. So only big people who have a lot of money, or they are called as high net worth individuals. Okay, or ultra high net worth individuals. Okay. So these are the HNIs who have a lot of money. They are looking for some kind of investment avenues. They invest into, and also when we say they are investing a lot of money into the private equity funds, their risk appetite would be very high. Okay, because of that only they come here. They take the risk. If things go well, they like both the parties get benefited, as explained in the previous point also. And the next important thing comes into picture is liquidity. We understood in the previous video, okay, like liquidity is nothing but the how easily you can convert your units or the shares to your cash back, right? If I certain point of time, if I want to get my investment back from the private equity company, then how can I do that? So simple answer to that question is the liquidity is not so good in terms of private equity funds. They are not liquid, they are illiquid. What do I mean by that? People are, if somebody is investing into private equity fund, they have to have some kind of lock-in period would be there, and they have to keep their investment at least for the couple of years. Okay, because they want to regenerate more returns on that. They want to the GP or the fund manager would keep the investment for a long term and look out for the high returns. So the moment they think that the things are going right, things are going well, then only they will take out money from there. Now the next question comes: what about the fees? What kind of fees are? Does it have fees like mutual fund and the hedge fund? Answer to that question is they are similar in terms of fees. If we are talking about, there are a lot of fees involved in terms of private equity fund also. Similar to the hedge fund, we have fees like custody fees, administration charges, legal fees are there, and taxation would be there, audit fees would be there, and whatnot. There's a big list of expenses when you are investing into a private equity fund. Okay, so there is a big list of expenses would get involved, and also management fees like that is to be paid by the fund to the GP. Okay. Okay, I think that's it about the private equity funds features I have explained you today. And in the next video, I will be making the comparison of mutual fund, hedge fund, and the private equity fund, how they are like similar to each other and how they are different to each other. Thank you for watching patiently, and I would request everyone to share this if you like it. Thank you.